a lender, Ready Capital. So Ready Capital just dumped $855 million worth of their debt on their balance sheet in distressed loans for pennies on the dollar. Okay. They're looking for operators like ourselves to step in and bail them out. Not necessarily bail them out, they're taking losses, but get non-performing loans off their balance sheet. Okay. Another lender, this was one of our lenders, is sitting on $1 billion, over $1 billion in multifamily delinquencies. Okay. Delinquent loans. Okay. So the extend your loan and not address your loan, the extend and pretend era is over. Okay. Most of these loans, ourselves included, we borrowed 3, 4, 5 years ago. We had 3-year loans with 2 1-year extensions, variable interest rate loans. They're bridge loans. When you buy an asset that has value add, you're going to get a bridge loan. You're going to do the value add, get it to stabilized, and you're going to refinance into a permanent loan. Well, when stabilizations were happening at the peak of the interest rates, the amount of loan that you could get decreased. So let's say you bought an asset for $25 million. You got a $15 million loan, bridge loan. Okay. $10 million of equity in the deal. And actually, that's a little bit more equity than most operators were putting in during that time period. But regardless, you've got a $15 million loan and you're wanting to refinance at stabilization. But when you got the $15 million loan, interest rates were 3%. When you stabilized the asset, interest rates had gone up to 8%, 7%, or even in today's market, 6.5%. Okay. Now all of a sudden, your debt to equity ratio or your debt service coverage ratio, how much income you make to how much your debt service is, has changed significantly. And so now at a higher interest rate, you're not able to pull out as much loan as what the first loan is. Okay. So your $15 million loan that you've got to pay off, your new loan, you're only getting $12 million. So you've got to come to the table with $3 million. Okay. Now, in our instance, we've been able to do that in most circumstances because we have 750 plus investors. We've managed over $300 million of investor capital. Many operators do not have that capacity and don't have the liquidity in order to do that. Okay. And so it creates an opportunity. The lender then finally gets tired of extending and they step in and they say, okay, we're taking this loan back. And then they start searching for an operator like ourselves to step in. Or the lender puts so much pressure on the operator that the pressure just throws in the white towel and says, I'm done. I'm walking from my equity. You can have the asset. And again, the lender looks for an operator like us to step in. Oftentimes, those assets have another $1 million to $2 million worth of value add to do. They've had deferred maintenance over the last 3 years that haven't been addressed, or maybe even 5 years and it hadn't been addressed. So the property has declined. So we need $1 million to $2 million to put into it. So the lender comes to us and says, okay, I've got this asset. I've got a $15 million loan on it. Okay. It needs $1 million to $2 million worth of work. Well, I know that new lender is only going to give me, well, they were going to give the original borrower $12 million if he could make that deal done. However, since this is a new purchase, it's going to be a little bit less leverage. So we're looking at probably $10 or $11 million in a loan. Okay. So current lender has $15 million loan. We need to put $1 million to $2 million into it. Okay. I'm not paying $15 million for that. I'm going to pay $11 million for it. With an $11 million payoff, new lender is not going to give me 100% of the payoff. Okay. They're going to give me 80%. Okay. So we're going to get $8.5 million loan. We're going to come to the table with $2.5, $3 million plus the value add. So $4 million. We're going to step into a huge opportunity to generate cash flow, huge equity, we'll get to participate in the appreciation in the market that we're buying in, and then tax advantages. Okay. And so we've got a very, very short window of this going on. Okay. Before either all the major hedge funds have stepped in and taken up the good, valuable assets and we're left with what's left over, or we start seeing interest rates really start to take effect and start to right size so that operators are able to refinance. Okay. And so it's going to be very short window. We've already had some of our lenders come to us and approach us with some of these opportunities, and we're looking at 3 of them right now. Okay. This is the first time, like I said, I've seen deals and underwritten deals that we're expecting to hit 20+% annualized rates of or IRRs, annualized rates of returns, affected for time value of money. Okay, is ultimately what the IRR is. So if you've got a 25% average annual return over a 5-year period, then you apply the time value of money to that. You take the 5 years that it takes to accomplish that and what returns come in that time, and your 25% average annual return hits 21-22% IRR. Okay, and so this is the first time in 3+ years that I'm seeing opportunities that are going to exceed 20%. Okay. And like I said, it's going to be a very short window. So we've got to take advantage of that right now.